Hello and welcome to this video on forecasting. In this video I'm going to give a demonstration of how to go through the 10-step forecasting template. So here we have the 10-step forecasting template and I'm going to go through in an Excel spreadsheet how to apply this to Australian Vintage Limited. You'll notice that in the forecasting template there's only a couple of things that we need to forecast. We need to forecast sales, asset turnover, profit margin, the net dividend payout ratio, and the net after-tax cost of debt, or net borrowing cost. With those 5 forecasts made, we can do a whole bunch of different calculations to end up with a calculation for our expected comprehensive income into the future and our expected ending equity balances in the future. So let's have a look at how that works for Australian Vintage Limited. So here I have the Australian Vintage Limited spreadsheet that I've been using. And in the previous tabs, I've entered in the balance sheet data, the income statement data. I've reformatted the balance sheet and reformatted the income statement and then calculated the free cash flows and ratios. So we've looked at all the historical information. Now we're going to be starting to use that historical information and our knowledge of the business to build the forecasting template. Now my aim in this video is to go through the calculations and the process of building the spreadsheet. The actual forecasts that I'm making are just going to be simple numbers just to show the calculation process rather than a well-researched or detailed analysis of the forecasting decisions. Okay, so I'm going to be using this 10-step forecasting template. So the first thing I have to do is forecast sales. And what I've done in building this spreadsheet, I've used the 2017 to 2020 actual sales data here. And I've calculated the rate that the sales have grown. So the current year's sales minus the previous year's sales divided by the previous year's to get a percentage change. And now I'm doing the forecasting. These rows that are in green are the rows that we actually have to forecast or estimate into the future. So I'm just going to say that I'm going to estimate 1% as my sales growth rate. Last year, we didn't have much of a change in sales revenue. And after doing all my research and understanding the industry and the strategy, I think 1% is going to be my sales growth rate. And just to keep it simple, I'm going to keep 1% as the sales growth rate for a couple of years into the future. So I'm going to drag that along. Okay, so this is the forecast that I've done. I now do the calculation. What would 2021's actual sales revenue be? I take my last year's sales revenue and I multiply by the 1% sales growth. So 1 plus 1%, and I get my expected sales revenue. It's going to be 1% higher than last year. And I'm going to drag that formula across as well so we can have it for each year. Okay, so step 1 is done. Step 2, forecast the asset turnover and calculate net operating assets. If I have a look at my asset turnover for the last couple of years, it's averaging around 0.68. When you do this for your assignment, you have to do more than take an average. You have to research changes in the business that would lead to potential changes in asset turnover in the future. But here, just in terms of applying it, I'm going to say I think the asset turnover is going to be 0.65 in the future. So that's my forecast. And we could put different numbers each year if we think the business is likely to change in certain ways. But I'm just going to keep it consistent for each of those years. So I've dragged it across. So I've now forecast asset turnover. I have to calculate NOA, my net operating assets. And in this spreadsheet here, I've given you just the calculations as well if you forget them. So it says NOA is equal to sales divided by asset turnover. So I take my sales revenue and I divide through by my asset turnover. And I then drag it across for each of the years. And I can see that in 2021, I think that my net operating assets is going to be a little bit less than what it was in 2020. Okay, based on the assumptions I've made, it looks like my asset base is going to be decreasing. Then I have to evaluate, does that make sense? Under what reasons would my net operating assets actually decrease? I'm now up to step 3 in the process, which is to forecast the profit margin and calculate NOPAT. So after looking at my profit margin the last few years, I'm going to say I'm going to be conservative and I think it's going to stay around the 4% level. Okay, so that's the forecast that I am making up. And I'm going to drag that and assume it's consistent for the next few years. So next, I calculate NOPAT. Profit margin times sales revenue equals NOPAT. So I now have my profit margin of 4% that I forecast, and I multiply it by the sales revenue. So that now calculates my NOPAT estimate for each of the years. The next step is to forecast any other comprehensive income. And for most businesses, this will average out as 0 over the future. If you know next year there's going to be some, for whatever reason, you've done your research and you know that there will be other comprehensive income in the next year, then definitely put that into your forecast. But on average, most businesses' other comprehensive income will average out around 0. So I'm just putting it as a 0 because that's the most likely thing. I'm now up to step 5, which is to calculate free cash flow. And I'm going to calculate the free cash flow based on my operating activities, which I've now forecast. Free cash flow is equal to NOPAT minus change in NOA. And I've just calculated NOPAT in step 3, and I've calculated NOA in step 2. So I can apply this formula. I can say free cash flow is equal to NOPAT minus the change in NOA refers to the current year's NOA minus the previous year's NOA. So I enter that in, and I can drag that across into the future. So for example, in the 2025 calculation, free cash flow is equal to the 2025 NOPAT minus 2025 NOA minus the previous years to get the change. The change in NOA is the current year minus the previous year. After we've calculated the free cash flow in step 5, this section of the forecast template finishes off our operating forecasts. So we now start thinking about the financing. So we're now concentrating on our financing activities, and the first thing we need to forecast in regards to financing is the net dividend payout ratio. We're going to apply that dividend payout ratio to our operating earnings to calculate the likely dividends would pay out in a year. So let's forecast the dividend payout rate. I'm going to assume it's similar to the last few years. I'm going to say 35%. Okay. And I'm going to drag that through. Now remember, the net dividend payout rate includes any share sales the company might have made. Okay, so D in our formula, or the dividend, is net payments to shareholders. So a dividend is a positive, and selling shares would be a negative in this. Okay, so we need to take that into account as well. Once I've done my percentage forecast, I can calculate the net payments to shareholders. So 35% payout ratio times my net operating profit after tax. I'm assuming a dividend of $3,777 would be paid in 2021. Step 7 is to calculate net payments to debt holders, and we use the notation F. The net payments to debt holders can be calculated as free cash flow minus any dividends. And the logic to remember this one is free cash flow is the money left over in the business after you've invested in all your operations. So free cash flow can only be used for 2 things. It can be used to pay equity holders, or it can be paid to debt holders. So if we've already forecast our payments to equity holders with dividends, the remainder must go to our debt holders. So net payments to debt holders equals our free cash flow of $31,000 minus the expected dividend. Okay, if we have $31,000 in free cash flow and that can only be used for 2 things, part of it has gone to paying the dividends and the remainder goes to paying the debt holders. Next up, I'm going to forecast my net borrowing cost. The net borrowing cost is the interest rate you'd pay on your borrowings. And I'm going to just use my recent year one. We've seen over this company's last few years, the interest rate has decreased, and that would be consistent with an industry analysis that would do. And I'm just going to assume that the interest rate stays low for the next few years. So with that low interest rate, we can now calculate the net financial expense after tax. And again, we've got our formulas here. Net financial expense after tax is how much interest you're paying. And we would be able to calculate that by NFO from last year, which is how much money we've borrowed, our net financial obligations, times net borrowing cost, the interest rate. So our net financial expense after tax is how much interest we pay, and it would be how much money we owed. So net financial obligations from last year is how much money we owe, multiplied by my expected interest rate, and that gives me my net financial expense after tax. I can then calculate my new net financial obligation balance. So I'll say my net financial obligations for this year is equal to last year's balance plus any extra interest I've had to pay during the year. So any balance for NFEAT would be added on to last year's balance, and then minus off any payments to debt holders, any debt that I've repaid during the year. And that will give me my forecast debt at the end of the year. So based on these calculations so far, it looks like we're paying off a bit of debt this year, and our overall net financial obligations are being forecast to decrease quite quickly. I can then calculate the leverage just to see if I'm keeping it stable or keeping it within sort of any normal bounds. I can do NFO over NOA, And I'm keeping it at around 25%, which is between the range it's been in the last few years. And now I've done those calculations, I'm going to drag them through to the next few years. And I've got a relatively stable leverage forecast going on here. I've been reasonably conservative with my estimates in this company. And finally, we can calculate the comprehensive income, which we know from the reformatted statements, NOPAT minus NFEAT gives you comprehensive income. And equity, calculate equity. NOA minus NFO is equity. And we want to just check that we've done it correctly. So owner's equity this year is equal to owner's equity last year plus my comprehensive income minus any dividends that I'm expected to pay out. They balance. I'm getting the same number when calculating it both ways, which is a good indication I haven't made any obvious mistakes. So I drag that through there. And just to make sure my forecasting assumptions seem sensible, I've also calculated what my forecast ratios are likely to be compared to the history, including what my return on equity forecast would look like. Okay, and it's a little bit of a sensibility check to make sure the assumptions I'm making would potentially be logical and something that may actually occur in the future. So to recap, in this demonstration, I have followed this 10-step forecasting template. In doing that, all I have to do is forecast, estimate, guess, whatever you want to call it, these items in green. That is a sales growth rate, an asset turnover, a profit margin, a dividend payout ratio, and the net borrowing cost, the interest rate. Once you've forecast those 5 items, you can calculate all the other items, all the other key items that would show up on your balance sheet and income statement. So that would be forecasting comprehensive financial statements, because we've got our overall incomes, our equity balances, we've got our operating and financing performance as well. This template's really helpful in it provides us a structured way of approaching the forecasting task. What it doesn't do, of course, is the hard part, which is making sure our forecasts are correct. So this is a structured way of going through forecasting, but the real hard work is doing all the research to actually have sensible estimates for the future of these green numbers that are our 5 forecast. Good luck in doing all the research for that, and I'll see you next time. Thanks, everybody.